here is something that should not happen. On Thursday the 18th of June, the S&P 500 jumped 1.7% and the Nasdaq surged 3.1% on news of a US-Iran peace deal. Risk assets across the board were flashing green. And yet Bitcoin, the asset everyone calls digital risk on, closed in the red at around $63,900, down more than 1% on the day. When the most volatile asset class on the planet refuses to follow a stock rally, something deeper is going on beneath the surface. Today, Saturday the 20th of June 2026, we are going to unpack exactly what that something is, what it means for your portfolio, and where the smart money is quietly moving. This is your complete crypto market briefing. Let us start with the hard data, because numbers cut through the noise. Bitcoin is trading in a tight band between roughly $65,200 and $66,000, with a market capitalization hovering around $1.33 trillion. That keeps it comfortably ahead of Ethereum, the second largest cryptocurrency, which sits near $1,670 with a market value of around $233 billion. The single most important figure, though, is the total crypto market capitalization. It has collapsed from an all-time high of $4.2 trillion back in October 2025 to just $2.18 trillion today. That is a 48% wipeout in roughly 8 months. Nearly half the entire market's value has evaporated, and that context frames everything else we discuss. So what triggered this disconnect from the stock rally? The answer is the Federal Reserve. On the 17th of June, the Federal Open Market Committee delivered its most hawkish decision in years. The dot plot, which maps where officials expect rates to go, revealed that 9 of the 18 policymakers now project an interest rate hike in 2026. Not a cut, a hike. For a market that had been pricing in easier money all year, this was a genuine shock. New Fed Chair Kevin Warsh went further still, scrapping forward guidance entirely and lifting the core inflation forecast, measured by the PCE index, to 3.6%. Higher rates and stickier inflation are kryptonite for speculative assets, because they raise the cost of holding things that produce no yield. Bitcoin felt that blow directly. Now, you might ask, why should a decentralized digital asset care what a central bank in Washington decides? It is a fair question, and the answer is liquidity. Over the past 3 years, Bitcoin has matured into a macro asset traded heavily by institutions, hedge funds, and ETF desks. When the Fed signals tighter policy, borrowing becomes more expensive, leverage drains out of the system, and the speculative capital that inflates crypto prices simply dries up. This is why Bitcoin now trades more like a high-beta tech stock on steroids than like the inflation hedge it was once marketed as. Understanding this relationship is essential, because it means you cannot analyze crypto in a vacuum anymore. The bond market, inflation prints, and Fed speeches now move your portfolio just as much as on-chain activity does. Let us zoom into Ethereum, because its chart tells an important story. ETH closed May down 12.6%, a brutal month driven partly by $401 million in net outflows from US spot Ethereum ETFs. Right now it is consolidating in the $1,660 to $1,680 zone. The key level to watch is the long-term support region between $1,500 and $1,600, an area that has historically attracted heavy buying interest. On the technical indicators, the 14-day relative strength index sits at around 42.5, which is neutral with mild selling pressure, while the MACD remains negative, confirming weak short-term momentum. In plain terms, Ethereum is bruised but holding above a floor that bulls desperately want to defend. If Bitcoin and Ethereum look painful, the broader altcoin market has been outright savage. Solana is down 47% year-to-date. XRP has fallen 38%. And meme coins, the most speculative corner of the entire market, have collapsed by more than 70%. This is what a deleveraging cycle looks like in practice. When fear takes hold, capital flees the riskiest assets first and fastest, and meme coins with no fundamental backing are always the first casualties. For newer investors, this is the single most important lesson of 2026 so far. The further out on the risk curve you sit, the more violent the drawdown when sentiment turns. Diversification within crypto offers far less protection than people assume, because in a downturn correlations rush towards one. But here is where it gets genuinely interesting, and where the smart money reveals itself. Even as Bitcoin and Ethereum funds bled capital, XRP and Solana investment products absorbed roughly $226 million in combined inflows. This is rotation, not pure panic. Investors are not simply fleeing crypto altogether. Some are reallocating towards assets with fresh catalysts. Solana became the fourth approved ETF category when its products began trading on the 26th of May 2026, and that cohort had already pulled in $1.118 billion in cumulative net inflows by the 12th of June. That is a remarkable figure for a product just weeks old, and it tells you appetite for regulated crypto exposure has not vanished. It has simply become more selective. XRP deserves special attention because its story is now as much legal as it is financial. Ripple's regulatory outlook has improved dramatically after the Securities and Exchange Commission dropped its long-running appeal, with a key approval landing in March 2026. New XRP ETFs have since won approval in several global markets. This regulatory clarity is precisely why XRP is being treated as a regulated-friendly altcoin, attracting institutional money that would never touch a token still tangled in litigation. The lesson here is broad. In 2026, regulatory status has become a primary driver of price, not a footnote. Assets that achieve legal clarity command a premium, while those stuck in regulatory limbo are punished. For anyone analyzing an altcoin today, the question is no longer just about technology, it is about which side of the law the project stands on. So where do prices go from here in the immediate term? For Bitcoin, analysts expect continued consolidation between $65,200 and $66,000, with an attempt to retest resistance near $65,900 to $66,000. A clean break above that ceiling would be the first sign that buyers are regaining control. A failure, and a slide back below $65,200, would suggest the hawkish Fed pressure is winning. For Ethereum, the playbook is simpler. Defend that $1,500 support and the recovery thesis stays alive. Lose it, and the next leg down opens up. These are not predictions to bet the house on, they are levels to watch, because price action around them will tell you far more than any forecast ever could. While retail investors often panic sell at the bottom, the behavior of large holders, the so-called whales, frequently tells a different story. Reports through May and into June show that whales and long-term holders have been quietly accumulating Ethereum during the dip, even as ETF outflows dominated the headlines. This divergence between weak headline sentiment and quiet accumulation is a classic feature of late-stage corrections. It does not guarantee a bottom is in, markets can always fall further, but it is a meaningful signal. When the people with the deepest pockets and the longest time horizons start buying what everyone else is selling, it is at the very least worth paying attention to. Smart investors track wallet flows, not just price. Looking ahead through the rest of 2026, three catalysts could flip this bearish picture. First, the Federal Reserve. If that hawkish stance softens and rate cuts return to the table, the liquidity tide could turn quickly in crypto's favor. Second, more altcoin ETF approvals. Products tracking additional tokens beyond Bitcoin, Ethereum and Solana would open fresh institutional pipelines. And third, the big one, a public allocation announcement from a major pension fund or sovereign wealth fund. A single credible institution adding crypto to its mandate could shift the entire narrative from risk-off to accumulation overnight. None of these are guaranteed, and timing is impossible to call, but knowing what to watch for is how you stay ahead rather than reacting late. So let us bring it all together. As of today, Saturday the 20th of June 2026, the crypto market is caught in a tug-of-war. On one side, a hawkish Federal Reserve, a 48% collapse in total market value, and brutal altcoin losses. On the other, selective ETF inflows, improving regulation around XRP, quiet whale accumulation, and a maturing market that is shaking out its weakest hands. The single most important takeaway is this. Crypto in 2026 is a macro asset, driven by interest rates, regulation, and institutional flows far more than by hype. If you want to navigate this market, stop watching for the next moonshot and start watching the Fed, the ETF data, and the legal calendar. That is where the real signals live. Stay informed, stay disciplined, and never invest more than you can afford to lose.